Hello, Smart Money Street podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with Neal Bawa. How you doing today, Neal?
Fantastic. Thanks for having me on the show, Kirk.
Yeah, glad to have you. So for those of you listeners who don't know Neal, tell us a little bit about yourself.
Sure. I am a technologist, a recovering technologist that accidentally fell into real estate for tax reasons. Uh, my degrees in computer science, data science is my area of interest, and um, worked as a technologist running a company from 1999 to 2015. And while I was doing it, making lots of money in, California, but, I'd like to call it Taxifornia. So I was not keeping a lot of money, and real estate proved to be the way for me to build my wealth and get out of a 9 to 5 job. So it took about 10 years, but it was a fun journey.
Nice. So as a data scientist, how does that play into real estate?
Well, amateur data scientist, but it plays into real estate really well because um, what I find is that while people in real estate are pretty tied to things like Excel spreadsheets for doing analysis, they don't go to the next step, and you really have to go to the next step, in my opinion, to set yourself up for better results. And there's so much room for analysis, data analysis, for comparisons of various cities and how they're doing in terms of job growth, population growth, income growth, home price growth. Now, you don't always get things right. Sometimes that research ends up taking you into the wrong direction, and that's happened to me. But the bottom line is that we end up significantly setting ourselves up for better returns or results when we use data science. So lots and lots of room there, and I'll give you examples of that beyond what the typical Excel spreadsheet analysis stuff that I think most people do.
Yeah, I mean, I'd love to hear some examples because I think what you're talking about is great and everyone should do it. Um, but I think, looking at demographic trends in cities is important. But, what are some examples of drilling down beyond that? Because I think there's probably a lot more you could do.
Yeah, absolutely. So the first thing is, let's say that Kirk and I are doing some water cooler talk. We both work for the same company, and we're talking at the water cooler, and Kirk basically says, I think Grand Rapids, Michigan is the place to invest in. And Neal Bawa says, I think Idaho Falls, Idaho is the place to invest in. Now, it may be possible that both of these markets are good markets to invest in, but which one's better and how much better, right? How do you quantify something like this? Let's say that I'm talking about Google, stock, and you're talking about Apple stock. Isn't there a very easy way to quantify and look at last 10 years of performance for Google and last 10 years of performance for Apple and the dividends? So one could objectively say things like, well, Apple stock has appreciated 3 times more than Google or 2 times more than Google. How about bringing that level of clarity, that level of objectivity to ranking cities for real estate, right? Which cities are likely to be more profitable? You can never say it with any level of certainty, but you can certainly improve your chances. So I became obsessed in 2008, 2009 with the idea of ranking cities for real estate investments because, as you can imagine, 2008, 2009, really bad time for real estate. And I'm interested in understanding what area is maybe the best. And so what we did is, as a group, I opened a meetup group in the San Francisco Bay Area, and there's a lot of technologists here, lots of geeks here. So it was a very geeky group of people, and we'd get together and basically figure out how to mine data. And the mined data came from websites like the Bureau of Labor Statistics website and Redfin, Trulia, Zillow, and sites like that existed back then. And when we would mine that data, we'd basically put it into, various software like a statistical analysis software. And we try to correlate real estate profits with the data. Like, is there a strong correlation? Is there not a strong correlation? Obviously, you want a strong correlation between real estate profits and data. What we found was there was strong correlation between job growth, income growth, home price growth, um, and crime reduction, um, and population growth. These 5 areas seem highly correlated to real estate profits. And all of them make sense initially because you're like, sure, that makes sense. Population growth, income growth, home price growth, job growth, all of those make sense. Crime reduction, that one makes sense too. But the devil is in the details because the question, like, my example that I gave you, Kirk, before of, Grand Rapids, Michigan and Idaho Falls. Well, both of those might have population growth, job growth, income growth, home price growth, and crime reduction. So how does one become better than the other? How much growth is beneficial? What population growth really would lead to aggressively skyrocketing rents? And so over time, it wasn't just the factors, Kirk, it was how much. So, for example, we need more than 1% annualized population growth for rents to increase aggressively. 3% job growth in a certain market can lead to very aggressive rent growth. 4% is phenomenal, and 5% is rarely achieved, but it's absolutely incredible because if a city has 5% job growth, um, everyone at that point is employed and everyone is very aggressively looking to rent, looking to buy. And so home prices go crazy, after which rents go crazy. So I think we were trying to figure out that sweet spot of growth, right? And then use that sweet spot to rank cities in the United States. So we look at, there's about 1,000 cities in the US, there's about 200, 300 some metros, 323 metros, I think, that the BLS has. And we were trying to figure out which ones are good. So based on that, I made dozens of home purchases in a metro called Madera, California. And on average, the prices there since that time, 2009 to now, have gone up 5x. Now, there's a few places in the US where they've gone up more than 5x, but not a lot, right? So Madera easily beat 99% of all cities in the US in terms of the multiples between 2009 and 2025 because of all the good stuff that was happening in Madera, job growth, income growth, home price growth. But it was much higher than other cities. So that's what we've done. We call it Location Magic. It's a toolkit. It's free. There's no subscription. We don't charge anybody for this because we know that it's incomplete information. It could be right. It could be wrong, but it's data driven, right? The key is not, I'm not saying that everything I say is right. I'm saying if you're data driven, you're probably going to improve your chances pretty substantially of making money.
I think that's great. I think it's great insight into how data science can lead to better decisions. I think it's certainly one of the things that leads AI in a similar direction is looking at I guess you'd call it machine learning, right? It's you're looking at big data and you're discerning things from that. Are you using AI at all in your processes?
We use AI incredibly. I mean, so we're an AI first company. And what that means is that each employee in our company is required to be highly competent in the use of AI. There is a minimum of one AI training per week that 100% of employees must attend, and also an AI demo session where you get to see what other people in the company are using with AI. Uh, you have to provide proof that you use AI for 1 hour a day, which is hard because 1 hour a day is a lot of usage. So everyone in our company has access to ChatGPT and Manus, our two tools that we use for AI. And we have currently over 400 documented um, helpers or tools that we have built for AI, over 400 of them. And we have, as a company, we have a goal of adding between 50 and 100 tools that we are using. And the tools are, they're not, some of them are fairly straightforward. For example, all of our investor updates, we will go into Monday morning sessions with our property managers and have these long, 60-minute conversations. Those get recorded using an AI tool called Fathom. That transcript is then put into a pre-trained ChatGPT string. We call them powered strings, and it outputs the report that is then edited by a human being to send out to investors. So we call it the investor update powered string. And it allows us to not have to remember or write down everything that happened in a property manager meeting for that 60 minutes long, 13 times a quarter. So once a quarter is when we're doing investor updates. So imagine us taking 13 very long 60-minute transcripts, putting them into a trained ChatGPT string, and it basically then outputs a very, very nice 10, 15-page report for investors. I mean, it used to be that we had to edit it and sometimes it would say dumb things. It's gotten better. It's gotten to the point where I know that the last few reports, we didn't edit a single word, right? So imagine that and then apply it 400 times across different domains in the company.
Yeah, that's great. I mean, I'm glad it's getting better. I think a lot of people struggle with the accuracy of it sometimes, and they struggle with, is this accurate? Is it coming up with hallucinations? What do you, I've found it's really not good at math. Like, how are you finding it with, I mean, you're talking about financial data. How are you finding it with math? Like, is it reliable enough to use, or do you use it in different ways?
We find that the other tool, Manus, which is a company that most people don't know about, but last week, 1 week before this podcast, Meta purchased Manus for $2 billion. So we find that when we have to do heavy number crunching, it's better to use Manus than ChatGPT. But I have to say that the release 5.2 of ChatGPT, which happened about a month before this podcast, is also, it's caught up a lot. It's caught up a lot, and we now are at the point where we are doing all of our rent comps using Manus. But when we have ChatGPT do that, it also does almost equally a good job. So, rent comps, obviously, lots of number crunching there. We also do our T12 analysis. So somebody sends us a random 200 unit multifamily property, and they send us the last 12 months of operating data. We are now using AI for that. It is crunching all of our numbers and telling us the weaknesses. Now, it makes mistakes sometimes, but what we find is actually it allows us to do things that human beings simply cannot do by themselves. For example, it'll go through line by line in the T12 and point out there's areas of potential fraud here because this doesn't follow the pattern. There's an issue here. There's a problem here. So when you have a very, very large document and you throw it into a powered string, it immediately gives you the top 10, top 20 insights, and it focuses our attention on what we should look for. We've found human beings miss more than half of those. So even though it occasionally gets numbers wrong, the positive impact of what it does is so dramatically greater that we are very, very committed to using it. And remember, AI tools, this is the worst they'll ever be because they improve every month.
Yeah. No, that's great. Yeah, it's definitely it's great that you guys are an AI first company. I think a lot of companies struggle with that. How are you are employees coming up with creative ways to use it, or are you guys just collectively saying, here's how we're going to use it? Like how are people using additional like, meetings and stuff like that?
So most companies have that challenge. We don't, and I'll tell you why, and it has nothing to do with AI. We are a traction company. There is a very famous book, a business book called Traction, which uses an operating system called EOS, which stands for Entrepreneurial Operating System. There are hundreds of thousands of companies in the US that are now traction companies. When you're a traction company, each employee in the company has to have something known as rocks, ROC, but rocks and pebbles and a rock garden. And they have to basically curate their rocks for each quarter, which are basically their goals. Well, we've set AI goals there. And so everyone basically now has to set goals or rocks that are tied to AI. And that makes it easier for us to hit our AI goals of getting 50 to 100 new tools every quarter. So again, this doesn't have anything to do with AI. If we were not a traction company, we'd be struggling with getting employees to be creative. But when you have a structure, an operating system for the company, which I highly recommend. I mean, Traction is a $20 book. You can buy it on Amazon. We didn't even hire a consultant. They told us to hire a consultant. We didn't. We implemented it ourselves. It took us about a year for the company to roll it out. But now that we've got accountability within the company using this operating system, we've simply basically made AI a platform of accountability. And so the employees are highly motivated to keep finding new ways to use AI. And we don't have a shortage. I'd be able to list at least 50 discrete areas within the company that AI has been used or is continuing to be used.
Nice. Um, okay, cool. So let's talk about some of the trends you're seeing, because I'm always fascinated with the trends in real estate. I know certain parts of the real estate market, like commercial, has gotten beat up a lot, and it's not quite recovered fully. But um, where are you seeing like interesting trends, both good and bad?
Well, so we'll talk about what I think is going to happen in 2026. I think that we're going to see small interest rate reductions. I know that there's a lot of political pressure on the Fed, but I think we'd probably see small interest rate reductions because our rates are now getting close to where they need to be. So you're not going to see a huge amount of movement in mortgage rates. So for those people that are listening that are interested in single family, I expect the mortgage rate to be somewhere between 6 and 6.3 on average for 2026, going down as 2026 moves forward. I also don't expect there to be a recession this year. I expect the economy will move forward a little bit better than last year, because last year we took on the impact of tariffs. And most people don't understand this, but tariffs are mostly a one-time impact. So the economy absorbed that impact in the second half of the year. And I think we will probably move forward faster this year. So I expect GDP growth to be a little bit better this year than it was last year, or 2025. I also expect rent growth to speed up. So if you look at rents in the United States, they were basically flat, depending upon which source you want to look at. Either they went up 1% or they were 0%. There's two different data providers that we look at. But bottom line is, obviously inflation is running close to 3%, 2.7%. And we expect inflation to actually slow down as well. A lot of that is tied to the price of oil. But bottom line is, if inflation stays at 2.6%, to break even, your rents need to grow at 2.6%. Well, they didn't. One provider says 0% growth, one said 1%. So we've had challenges, from a landlording perspective in the US. We've also lost some occupancy. So the US market was about 94% occupied at the end of 2025. It was a little bit more occupied at the beginning of 2025. So we lost some occupancy. So there's, from a rental perspective, there's going to be recovery. If you're a home buyer, the trend is that you actually will have more buying power in 2026. Why? Because I think home prices are only going to go up 1 to 2% in 2026. Salaries are going to grow up 4%. So if your salary goes up 4%, your home price goes up 1 to 2%, you have slightly more buying power to purchase property. So we expect about 4 million single family homes to be sold in 2026, which is similar to the 2025 run rate, but slightly higher.
Cool. So one thing that's always puzzled me, we've had a lot of real estate professionals on the show over the years. Um, you know, if you look back decades, typically higher interest rates equals lower real estate prices, lower interest rates equals higher real estate prices. But that's not what happened in 22. An increase in interest rates led to an increase in real estate. And now that rates are going down, I wonder if real estate's going to start to come down in value. So what are your thoughts on that whole dynamic? Because it's how it should work, but apparently the mechanism is broken because it didn't work in the last few years.
Well, I would dispute that. It didn't work for single family, it did work for multifamily. So as interest rates went up, multifamily prices or apartment prices went down. They're down about 20% in the US. Some markets are down 30% or up to 30%. So there was a very smooth reduction in multifamily prices when interest rates went up. Very smooth, very tangent, very similar at the same time, very parallel. Now, what didn't happen is single family. So when interest rates went up to all the way to 7%, you expected home prices in the US, which had gone completely crazy, completely ballistic in 2021, 2022, to come down. And they did not come down. So there was a break there. And that break was tied to something known as the lock-in effect. So when the Fed cut interest rates to zero in 2020 and 2021, mortgages became so cheap that people like me, tens of millions of people, refinanced at 3%. My 15-year mortgage rate is at 1.75%. And most people that I know that refinance during that time, they're at 3% or 4%. Some are at 4.5%. All of those are very low numbers compared to mortgages now. So we effectively couldn't move. We couldn't change anything. We couldn't, pick up a new job. We couldn't move to a different city. So there was a very strong lock-in effect because of the extraordinarily low interest rates and then extraordinarily high interest rates within an 18-month time frame. So you went from all-time low interest rates to not all-time high, but very high interest rates. And that difference was so huge that it created a lock-in effect. And that lock-in effect reduced single-family inventory so much that at one point we only had 50% of the typical inventory. If you don't have enough homes in the market, you're not going to see prices fall. Now, inventory has been steadily climbing in 2025 as the lock-in effect slowly wanes. It is waning. We've seen it wane. And so this is why I'm predicting that in 2026, we might only get 1 to 2% growth in home prices. We don't think home prices will go down. So the lock-in effect was what broke the market, and it prevented single family prices from going down. That was not the case for multifamily. So it was half a break, not a full break.
So by that logic, and I agree, that seems to be what happened. A lot of people I talked to, I thought it was interest rate driven. A lot of people said no, it's supply and demand driven, which I understand the lock-in effect for sure, because people can't move. I mean, if you're in a big house and you're going to downsize and you're going to have a mortgage rate that's, double or triple what you had, well, you're paying the same monthly bill. You might as well just stay where you are, right?
Exactly.
So, but by that logic, that would say that as interest rates drop, those people should free up, which should drop single family home prices.
Well, I think that we are seeing challenges in the single family home prices in 2025. So, rates have started, they didn't really drop until the end of the year. So one of the key things that you have to understand is when the Federal Reserve drops rates, that doesn't mean that mortgage rates immediately go down. So through last year in 2025, I think we had 4 rate cuts, so about 100 basis point or 1% drop. And we didn't quite see mortgage rates drop by 1% until the end of the year. So close to the end of the year, we started seeing that drop. So as we are seeing mortgage rates drop, we are now seeing more buying activities. We are seeing people selling those homes that have low interest rates and starting to move out. We're at the very beginning of this process. But at the same time, there's people who haven't been able to buy for the last 5 years or 3 years because the interest rates were too high. So now you have those people that were sitting on the sideline that are coming in. So net, I think home prices are going to be flat, which is unusual because they tend to go up 9 years out of 10. But I don't think that they're going to go down. No.
Okay, that makes sense. Um, Now, one area that's obviously been, you know, beaten like a mule is the office sector, commercial real estate. What are your thoughts on that? I mean, that's still kind of a hot mess. So, what's your take on that?
You know, um, you realize that if you bought a single family home in 2009 or 2010, you would do incredibly well, right? But in 2009, 2010, you couldn't find a single person that would not call the single family market a hot mess or a very hot mess. So understand that when it's time to purchase, you've got to buy a little bit early before all of the recovery happens. Because once you're 50, 60, 70% of the way into recovery, everyone knows that information. And so you lose buying power. I think that the office space is beaten down at this point of time, but it's slowly on its way to recovery. And there's a number of factors. First, we are seeing very strong, um, back to work sort of movements, right? So the return to work sort of movements. More and more companies that were saying 2 days a week are now saying 3 days, 4 days, 5 days a week. There's some companies that are saying, okay, you've got to come back to the office 5 days a week. So we are seeing a continuous increase in the percentage of workers that are going back to the office. And obviously that increases office space usage. We are also not seeing any new construction in office. We have not seen a new construction in office for 3, 4, 5 years. So what I'll tell you is, I do not believe that the office market is going to melt down. I believe that we stay in the doldrums for all of 26, maybe in 27. But I do think that that market is approaching its bottom. I do not think that its prices are going to go down further. They've gone down a lot. I mean, some markets, they've gone down 30%, some markets 40%, some markets 20%. And I think that no one can time the bottom, and I don't even try, but I think that we're close to a bottom for office. Especially because I think that there's now starting to see some pressure where companies are coming back to the office. Now, it varies. Areas that are strong on AI, like the San Francisco Bay Area, are seeing huge demand for office space, and other areas are not quite seeing it. So it varies, and I'm giving you sort of an averaged out picture.
Okay. What where are you seeing the best opportunities right now? Like if you had to pick a spot in any market, any kind of real estate, like where are you seeing the most uh interesting opportunities?
It's very hard to find interesting opportunities right now because you might say, well, you're saying prices are down 20%, 25%. So I'll say there are niche opportunities. Like on the multifamily side, there are markets that have a lot of distress. there's opportunities there. I'll give you an example. This is not my deal. I wasn't involved, but I know about this deal through friends. A multifamily property was going back to the bank, and the bank allowed the new buyer, so there was a new buyer, to basically buy the property with a 10% down payment, where most properties today, if I want to buy a property, I have to put 30% down, 70% loan. But this property was allowed to be a 90% down, 10% equity. I've heard of three or four of these kinds of properties. So what I would say is, there's opportunity in distress. There are pockets of distress in the multifamily market, especially in the Sun Belt, and people are getting good deals. But it takes a lot of work. There's no across the board distress. Lenders are very careful. They want to kick the can down the road. 2025 was a classic kick the can down the road year where there weren't a lot of closing happening. There weren't a lot of defaults, foreclosures. Banks basically, if you gave them a reasonable pitch, banks would allow you to kick the can down the road another year. So we saw a lot of that happen. It's going to be a little bit less of a kick the can down the road year, so that more properties will come into the market, and that's where the opportunity is on the multifamily side. Single family is very expensive. I believe single family is overvalued by at least 10 to 15%. So there's very, very few areas of interest there. Industrial is very expensive. Normally, I would say industrial is good because of the need for AI. But overall, industrial is very expensive. Cap rates are low, which means prices are high. So I hesitate to recommend industrial. I think there are pockets where senior housing could be a great opportunity because we every year now have hundreds of thousands of people retiring. Some of them have the money to go live in a senior, home. And so I think that there's opportunity in senior housing, but one has to be careful.
Okay. So one area that people don't talk about enough is private credit. I know the banking system is more or less improved since 2008, but the private credit market seems to be having its own share of issues that we don't really see readily because it's not regulated. How is how, if at all, does the private credit market impact what you do in real estate in general?
Well, I would say that private credit, where essentially, let's say I have $1 million and I give this $1 million to Blackstone. Blackstone is the largest private credit provider. I'm a Blackstone customer for all, as a disclosure. And I am a Blackstone private credit customer as well. So I analyze what companies that they're giving this credit to. Overall, I feel that private credit is not a bubble. I think that they need to be more careful. There's definitely some frothiness there, and I'm watching it very carefully. Some companies like Blackstone have better customers. Others are basically giving the private credit out to companies that are second tier or third tier. So you've got to pick the company that you're investing with very carefully. I do think that over the next 2 or 3 years, I'm going to withdraw all of my private credit money because, as that private credit, ball grows, eventually it's going to turn into a bubble. But I don't get the feeling that we're there yet in terms of private credit. But again, it's a significantly more risky market than money market. So everyone that invests in private credit should understand that they're investing at a significant level of risk.
Yeah, I think the challenge with private credit is we don't know what we don't know, right? The funds are private, they're not regulated. I know when I start to get 20 calls a week from these funds saying, "Hey, you should invest in our fund," it usually means they're trying to get out. Some wealthy billionaires put money in there is trying to get out, so they're trying to sell it to me. It's always obvious when they do it because I get tons of calls. Right now, I'm not getting any calls. But in 2000 and was it 22 or once interest rates started to go up, I was getting peppered every single day. Oh, we got this great deal. KKR is selling this. I'm like, do I want to buy from the partner of KKR? No, I'm good. So I just wonder, because there's a lot of areas where that's impacted. Certainly, the auto sector is kind of interesting now. But cool. So as we kind of wrap it up here, what are some kind of final thoughts we can kind of take away from investing in real estate, given what's going on in the world right now?
Um, I think that there's some green shoots. With the last 3 years have been bad for real estate, other than single family, which did okay. I'll just say, because single family did go up a few percent every year. I'll just say 3 years of okay for single family, 3 years of terrible news for commercial. Now you've got some green shoots. 2006, 26 may still be a transitional year, but I think that one of the biggest impacts of everything that we're seeing, the affordability crisis, is less and less Americans are able to buy that starter home. I'll give you two numbers. In 2025, only 21% of all homes sold in the United States were first-time buyers. One out of five. That's terrible. And did you know that the age of the first-time buyer is now 40? It used to be not very long ago, around 30. So now the first-time buyer is 40 years old and only buys one out of five homes, with investors buying more homes than a first-time buyer. So America basically has a very severe housing affordability problem, a very severe one. We're not finding any ways of fixing it. Politicians on both sides of the aisle talk about it, but I haven't actually seen anything that significantly makes a dent. Sometimes they do things that get headlines and get them elected. That's good. But I'm not seeing anything that makes a significant dent. So we expect the housing crisis to continue for the next 5 to 10 years.
Okay, good. That's great insight. Well, Neal, I appreciate you coming to the show, sharing your wisdom with us. Where can people find more about you?
Well, so we tend to hold data-driven webinars, usually 6 times a year. Thousands of people attend these webinars every year. And the best way to attend them is to go to a website called multifamilyu.com. Remember, the webinar is about other things like Airbnb, AI, all kinds of things, not just multifamily. But the website is called multifamily followed by the letter u.com. And if you want to basically look at all of our previous webinars, get access to our library, which is completely free, no subscription, no upsell, you can go to multifamilyu.com/club. So you join the club. It's a free club with no upsell, no second tier, and no subscription. So if you're data driven, you would love the webinars that we hold.
Nice. Awesome. Well, Neal, appreciate you coming to the show, sharing your wisdom with us. We'll have you back on the future. So thanks again.
Awesome. Thanks for having me on, Kirk.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room.
All right, that was a great interview with Neal. Appreciate him coming to the show. Now we're into the panel portion of the show. We have our very own Barb Friedberg. Hey, Barb.
Hi, everybody. Happy Wednesday.
Happy Wednesday. And we also have our very own Mark Walton. Hey, Mark.
Hi, afternoon to you both.
Great. Well, glad to have you as well. So, Barb, let's dive right in. You're a real estate gal. What are some of your takeaways from the interview?
I am a real estate gal. And to be honest with you, I thought this was fascinating, all this data that you use to choose markets, because I started out back in the day before computers. So, real estate investing has come a long way. And I think the idea of really drilling down into finding out what is the growth rate of the population, what is the potential growth rate of rents, et cetera, is all very, very useful and interesting. But the bottom line is, in whatever asset you buy, you have to buy at a good price, or the potential appreciation or the cash flow is not going to work out. But good, a very good strategy to look into to add to your toolkit of existing real estate analysis tools.
Great. And Mark, what were some of your takeaways?
Yeah, I thought it was fascinating as well. I think at some at kind of an upper level to be able, especially with the size of America, to be able to pinpoint areas to focus more on. I wasn't sure at what point the human element comes into thing and boots on the ground and going and looking at buildings and talking to people is because I bought real estate on a retail level, so individual properties over the years. We were always taught, get to know the area, go into the local shops, find out what the word on the street is, and get a feel for an area. So I wonder whether he makes all the decisions from the data, or one would presume at some point that people come into the equation. Because otherwise, if this is the way the future's going, that none of his staff will have a job in a year or two's time because he was talking about ChatGPT. They have to use it an hour a day, I think he said. And then it also, I mean, if you look on that in the general scope of things, we were talking earlier about the hedge funds. The hedge funds underperform. The majority of them underperform the S&P. Well, if they've got 5 trillion under management, why do you need it anymore? On the basis of this, you just do it all from data.
Yeah, that's a great point. Um, yeah, it's interesting. I've been having conversations this morning. They all been kind of mirroring the same thing, which is it's the framework of generations where our generations are certainly have escaped this, but the younger generations, they can't buy starter homes because they're too
No,
expensive. Because they can't buy a starter home, they can't get that step up and the step up. So if you don't get in real estate early, it's hard to get into real estate. It's
yes,
just the way it works. Um, I think the same framework applies to jobs with AI because some of if I think of people that are in like research, let's say, their research department, they're laying people off at the lower end because why pay them? I'll outsource to India or AI. Well, the people, who are going to eventually be a manager in that role are not getting hired because they can't get the introductory job. So if
yeah.
they can't learn it, then you can't become a manager. So the managers are moving up. Well, they're not managing anybody because it's just AI and outsourced to other countries. So it becomes this circular problem of the next generation. Like all the jobs are just getting. It's like you're going into the ocean. You're like, hey, I just graduated college, and the tide starts going up. Like, hold on a second, wait for me, and you just
Yeah, yeah.
you just can never get in the water because it just keeps going out and out and out. I
Yeah.
think that's one of the biggest challenges we face is generationally, is the next generation, the jobs are just getting sucked out because the lower end jobs are getting fewer and fewer, and so where do you go? So
Well, I
that's
think I think two big things there. He talked about that the average first-time buyer in America now is 40 years old, where it used to be 30. And he also spoke about that I think it was 20% of purchases last year were first-time buyers, whereas in the past it would have been significantly higher. So if people are not getting on the ladder, then that makes you wonder on independent individual homes in the future, what effect is it going to have? Because we had the same scenario in the UK. I mean, in the UK, every 8 years, the price of property since the Second World War doubled. And so, as an investment, once you've got more than one property, it was always a very solid investment. And now, because the younger ones can't afford to buy to get on the ladder in the first place, it makes you wonder where they go next, unless they inherit. I mean, there's a lot of younger people now are going to inherit baby boomer money. But yeah, the whole thing is it's a different world, isn't it? It's a different world.
yeah, yeah, it certainly is. So Barb, what are some of your thoughts from the interview about, the quant approach to real estate?
I think it's a nice approach to add to your toolkit. And as you and Mark were both discussing, the whole landscape has changed from job growth to real estate investing. And although it's easy to get stuck in the past, especially for those of us that have been around the block once or twice and say, well, back in the good old days, I could buy a home in Cincinnati, Ohio for, $40,000 and rent it out and be fine. Well, we've got to change our mindset. And, I don't remember what your question was, but I think
Quantitative
it was
approach to
the
research, Barb.
what?
What you think of the quantitative approach to research
I think the
to real estate?
quantitative is going to be helpful to integrate into your real estate research. And the question is, we've got a systemic problem because there isn't enough of housing available. There's enough commercial, but retail, single family homes, there's not enough supply. So that's one big barrier that we have. And hopefully we will reverse that over time. And I think we probably will. So that aside, we really need to use all the tools that you possibly can to evaluate real estate, either for buying your own home or for investing, because there are still places to invest, but you have to be a little more flexible. So, for example, I live in San Jose, California. This is ostensibly the most expensive place in the country to live and the housing prices are ostensibly the highest. So what do you do if you want to get into real estate here? Well, there are options. Let's say you maybe invest in a mobile home and rent it out. Those you can get into cheaper. Or you go out a couple 100 miles and you go more to the inland and you invest there. And that's where the data can help, because you can look at, okay, so what's the population like in Truckee, California, or in Sacramento, California, close enough that I can drive there in a couple of hours and find some real estate to invest in there. But you can use your analysis of items that you wouldn't have thought of before. Like Mark mentioned, you walk around, you look at the neighbor, all that stuff. I still believe in that. But if you could also look at what's the demographic, how much is the area growing? How much are rents increasing? I think that can be amazing tools to use when you are investing in real estate. And I think you can do it on your own. All of this stuff is publicly available demographic information.
Yeah, that's great. I do think it's I find real estate fascinating. I always have, and I think like many assets, one of the benefits of real estate is its illiquidity and its a lack of easy to access information. Is that allows a discrepancy in pricing, which allows you to get good deals. Because if everything was perfectly priced, like the stock market where everybody gets the same price, there's no strategic advantage to doing the research, right? You can, but you don't know where the prices are going. With real estate, you know, Barb could do a ton of research in her local area and find this property that's underpriced and is clearly a great deal, whereas I won't know because I'm just looking online on Zillow and I don't see it. That's a really great advantage to real estate that unfortunately will disappear the more it's systematized. Go ahead, Barb.
I want to chime in something else because we moved to this area in 2011, and that was right after the mortgage meltdown, and real estate prices had tanked. And so we got our house that we live in now, that we bought in 2011, for actually less than the cost that it was charged when it was newly built back in 2002 because of the market crash. So another strategy, and this is a long-term strategy, but it also applies not only to real estate, but to the stock market and to other financial markets, is periodically downshifts in pricing due to a number of factors, whether they be economic, whether they be geopolitical, but all markets at certain points are going to experience some significant drops. That is the time when you need to have some money on the side and to be ready to buy. It's scary, but it's also the time when the greatest profits are made.
Yeah, I agree with that. And where I was going with this, what I think is interesting is, you know, I remember the tax lien market when it was not transparent. You could get 10 to 16% yields a year. And it's one of the least risky asset classes out there because it's backed by real estate and you have priority status. So if a bank has, you know, a mortgage on it, you take priority over that. You take priority over everything except for the IRS. To me, it was one of the best asset classes when it didn't have transparency. You had to go hunt for the stuff. You had to do all this manually. You could get great yields. As soon as that went online, they were doing online auctions, which happened in the late aughts, early tens. You couldn't, they were getting like 25 basis points for these things, or like 1% for these things. You're getting like the lowest yields possible because institutions just wanted paper and they knew it was really secure. So you lost all that yield because of the transparency, because of you know, the easy access to information. So in some ways, it squeezes all that extra margin and that benefit out. So you know, hopefully real estate still retains that somewhat, but I do like the direction of the quant-driven investing. Mark, what about you? What's your opinion? I know I don't think you're a real estate guy necessarily, but what's your opinion on all this?
I think Barb made a really good point about the crash because obviously 2008-9, when everybody was struggling for cash, that was the time to buy. And the other thing, I don't know what it's like in the States, but in the UK, for example, I talk to people in London, younger people, and they say there's no way they can afford a house. And I say, well, yes, you could afford a house if you moved 100 miles out. And if you moved a few hundred miles to the north of England, which is wrongly has a reputation for being a rougher, and it's not. There's some beautiful countryside up there. You can buy a substantial house for a few $100,000, and I'm talking 4 or 5 bedroom house. So I read years ago a thing, and again, I don't know if it applies in the States, but in the UK, they say that the majority of people end up living within 15 miles of where they were born. So for anybody wanting to buy a house near to the area where they're born, I have a friend, a retired taxi driver, and from London, he bought a house in probably 1980 something for £20,000. And that house now is just sold for 1.6 million. So there's no way in the last 25 years his kids could have afforded to buy property in that area. Having said that, London has had a situation as well where you get again, they've extended the tube lines. So areas that didn't have a good infrastructure for transport, etc., that were a lot cheaper have been coming up the last few years whilst this new system's being built. So again, if you're kind of opportunistic, but this is old school. This is boots on the ground. This is not going through data. I think the data makes sense for a big company. I think it makes sense for a big country, and it depends on the level of real estate we're talking. I say I was individual units. One of the creative things that's going on in the UK now, a lot of the single units are being converted into 2 or 3 bedroom single apartments, and they class them as a house of multiple occupancy. And so for a neat property you might have got $1,000 a month from, you can now get 2,500. So I think people being creative with property, people willing to move, and like Barb gave the idea of going 100 miles away, I've suggested the same thing. But I say data, for me, at the end of the day, I was buying property based on the local area, jobs, all the things actually he's talking about, but it was done from more on the boots on the ground perspective.
Yeah, no, that's great. So, um, you know, I mean, right now with real estate where it is, Barb, What are some of your thoughts? I mean, should people be looking at real estate now? Because, I mean, there's so many, we talk about this in the show a lot on how we were just kind of scratching our heads and how interest rates went up and real estate prices went up, which is not supposed to happen. Um,
I think you can find deals at any point. Um, and I think we talked about mortgage rates, and you brought up a good point in the interview, Kirk, which is typically when mortgage rates are low, prices are higher. When they're high, uh, prices tend to stabilize. So, you have to look at mortgage rates because those are a big input into how much it's going to cost you to manage the property and how much profit you're going to have. So, should they look at real estate now? Yes. I mean, there's always deals to be found, but right now real estate's not cheap as an overall asset class. But I'm going to posit something a little more unusual. And I think this is where you have to get creative. We have a surplus of commercial real estate now with the advent of so many people working at home. We have tons of commercial property that is literally vacant. Any city you go to, you can find that. Now, there are companies that are being creative and they're going in and they are turning those into residential housing because we have a lack of residential housing. We have a surplus of commercial real estate. I believe that is depending on zoning and the possibility of being able to change the zoning, I think that is a tremendous opportunity for someone, or you get together a group of investors, buy a commercial property, turn it into residential. And I think the profit potential there is tremendous, or going like Mark and I've been saying, outside of a metropolitan area, because all the big cities are expanding and their borders are growing and growing and growing. And that's where you will find more opportunities. Within the big cities, not so much.
Interesting. So, um, so Mark, what do you think of in general the quantitative approach, to financial markets? And I'm not sure you're a quant necessarily, but it is a part of investing in the markets, and some people use it pretty religiously. How do you look at that? Do you think it's a valuable approach?
I think that the world is changing, and again, going back to the idea of AI and the performance of a lot of the hedge funds, you could see more and more decisions being made from a quant approach. And again, I don't know. I think at the end of the day, I mean, everybody quotes Buffett, although I think in the last 10 years, his performance wasn't as great as previous years. But I still think that there's room for individuality, people who are willing to kind of go against the flow a bit like Barb's scenario with the house purchase. When everybody else is panicking, there's blood on the streets, the time to buy. I think the other danger with everything being automated and quant based is surely you're just going to end up with things going up and down on a daily basis while the big banks are shifting bits of paper around, and it would destroy the whole industry. And the S&P, I believe, is more than the GDP of the rest of America put together. So the banks make a lot of money from it. The funds make a lot of money from it. I don't know what the end point would become. And like you say, I mean, if you're going to end up with more and more people with no jobs, then that's going to continue to have this effect on the housing market. I thought I read it in America. Isn't Trump trying to stop the big companies buying single units now as well?
Well,
Yeah,
he is,
they
but
go ahead.
Kirk, I don't know what you think, but I don't think you can legislate who buys what.
Hmm.
There are a lot of things that the politicians say they're going to do, but I don't see how he has the power to do that. Do you, Kirk?
Uh, I do see how he could have the power to do that. They could. There are things they could be done because those financial companies are regulated. So, we are too, and I'm sure there's a lot of influence that could be put on our industry indirectly if needed. And given the government we have now, things happen whether they're legal or not. So, I'm of two minds on that. I think it's an interesting topic because I do think that financial companies buying up all these houses, manipulating the housing price is bad, right? We're talking about housing. We're not talking about investing. We're talking about people
Mm.
have to live somewhere. Cost of housing is going up in large part because these companies are buying it and they're taking inventory off the market. So I don't think that's great. I also think there's a potentially really negative consequence down the road. If you look at places like Europe where a lot of people rent, there's not a lot of appreciation in real estate like there is here because we're getting more growth and Europe is more static. Um, but if you think about it, like what if institutions own all the real estate and you had to be a renter, you couldn't be an owner? Well, that's a problem in itself. So I think from that perspective, I really don't like the idea of companies owning residential properties, single family homes, and be very clear. And I think what was discussed was um, financial institutions or companies not owning individual homes, like not multifamily, not apartment complexes, which I think is different because those are naturally rental properties. But when you start buying individual properties and then making them rentals, in my opinion, it's maybe not setting the best precedent. Um, but I also don't like the fact that the government's legislating on a free market. So I'm of two minds on this. I think from the big picture, I don't like the fact they're doing it, but I also don't like the fact that they're legislating what the free markets can do. So I can see both sides. I agree with both sides. I don't mean to be a waffler. I just don't know what the right answer is. All right. Well, as we kind of wrap it up here, final thoughts from you, Barb.
I think for a creative investor, there are always places to go. When you're investing in real estate, when you're investing in all sorts of assets. But when you've got, in general, for example, appreciated individual housing, appreciated small multifamily housing, it makes it much, much, much harder. But that said, I would encourage those of you that really want to get your hands dirty and get in there and start owning real estate. It is a great asset class. And what Kirk said about the illiquidity is so important because less liquid assets and location specific assets do create opportunities. So I would definitely say do your own analyses, look at the numbers, the traditional, income, expenses, etc. Throw in a couple of data points, get inspired a little bit by what Neal was saying, and you may have to work a little harder, but in the long term, real estate is still a great way to amass wealth.
Awesome. Where can people find more about you, Barb?
You could find me on YouTube at Barbara Friedberg. You could find me online at Barbara Friedberg Personal Finance. See you next time.
Awesome. Thanks, Barb. And Mark, final thoughts from you.
I think if you're going to go out of state, then starting with data makes perfect sense because that can help you to zone in on an area. I thought Barb made a really good point about property that's at the moment is commercial real estate and retail converting to residential. In Europe and the UK, there's so many places that closed after COVID that will never reopen. And at the moment, they're desolate. I think creativity comes into real estate and always has done. I was buying in the early 2000s. I really started buying houses for income in the 80s when you just bought the single units, and it was great because you could borrow money and from day one you'd be making profit. Now people, as I said earlier, splitting houses into twos and threes, perhaps switching in retail, but look at areas. So I would certainly look to start with data, but at the end of the day, I still think boots on the ground is the big thing. And as Barb says, you need to get your hands dirty. But if you like that kind of thing, it's a great business to be in.
Nice. Where can people find more about you, Mark?
Again, you can find me on YouTube, on X, and the main website for us is forexmentorpro.com. And we teach people how to trade and how to invest for themselves.
Awesome. Well, thanks for coming on. Thank you both.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.